Let's talk about SoFi. Let's talk about everything that has happened with SoFi throughout the week. We've had ups and downs, mostly downs, let's say one up. Why is that? Well, the up one is because of the CPI report. Inflation numbers came in a little bit better than what was expected. It rose 3.3%. If you exclude food and energy, that was 3.4%. Now, okay, fine, we're, let's say, trending in the right direction, but overall, if you zoom out and look at what happened in the last 4 years or so, inflation is still extremely high. So yeah, don't expect cheaper prices across the board anytime soon. Rate cuts, yeah, expect a rate cut this year and then a couple of more in 2025. Now, of course, when that news came out, a company like SoFi obviously benefits from rate cuts, so that stock went up. How long did that last? Not long at all. Because after that, we had one CFO talks with Dan Dolev of Mizuho, which was pretty positive, which I'm going to cover in just a second. And then, second of all, their fourth largest shareholder filed to sell the shares. Plus, we've got an even more updated filing where he already sold the shares. I'm talking here about the Qatar Investment Authority. So they filed a Form 144 to sell all of their shares, the fourth largest shareholder of SoFi. So of course, huge red day, huge pressure, retail panicking as always. Of course, it's not nice to see your fourth biggest investor, shareholder sell all of their position, but maybe there's a reason behind that. And yes, there might be a solid reason behind that. Before going into that, if you enjoy this type of videos, leave it a thumbs up, subscribe if not, we really appreciate that. Want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So first of all, today, Friday, July 14, the Form 4 was filed, which means they sold already all of their shares, which also means that the pressure should be off the stock right now. All of their shares were sold at an average price of $6.78. So that story is done. But what's the reason behind the selling? Well, Timothy here comes with a pretty good explanation, something that I've missed before. So let me read. By the way, go follow him. I did follow him, so I don't know why this is on. Okay, never mind. Anyways, he says here, put into perspective, the Qatari Investment Authority had approximately $315 million in preferred shares that were redeemed and 12 million warrants that expired worthless. That happened not so long ago, which would have represented a total value of investment of about $400 million. They had 20 million common shares left, equating to about $140 million. The bulk of their investment was in preferred shares with a large guaranteed return pre-IPO. He says that they had to retain 50% of their investment to retain their seat on the board. And although they were on the ballot and confirmed to the board in the annual meeting on May 21st, 2024, the preferred wasn't actually redeemed until May 29, 2024. So at that time, they effectively would lose their required seats, and they likely sold because of their decreased investment and lack of a board seat in the future. I'm pretty sure that there is no other reason, but I'm sure someone will say that, well, they could have bought more with their preferred proceeds, so maybe you could view that as a negative. Yeah, fair point, fair argument. He ends by saying they aren't a classic institutional investor, they got a great return on their preferred and SoFi investment and moved on when that return was no longer guaranteed. SoFi no longer needs them on the board, and their lower level of investment doesn't warrant a mandatory board seat in any event. And so that might be a pretty good explanation. Of course, unless they really believed in SoFi, then probably they would have added more to their position, got their board seat back, and see their investment for the next coming years, see what happens. Clearly, didn't interest them to see what happens with SoFi in the next couple of years, only interested them to get a board seat, and now that that was not secured anymore, they sold it all, moved on to other things. Okay, fair enough, thank you, goodbye. Now with regards to SoFi, the last video was SoFi is not a good stock, right? Or something like that. And to be honest, yes, SoFi is a very, very retail active stock company, or at least that's what I think. But despite that, it's always the same mistake that happen, right? When the stock goes down, retail sells. when the stock goes up, retail buys. You don't believe me? Here's the proof. A screenshot coming from Robinhood. As you can see, June 12, our customers' sell volume percentage increased by 19% versus the last trading day. This is not investment advice, but as you can see, this pattern has not been happening just for one day, but when the stock is red, retail sells. But then if you look at the large scale orders in the last 5 days, well, you can clearly see the big green candle. Of course, we won't get the updated institutional holding holders for I think a month or two. But I mean, it's not that difficult to put one and one together. And if we look at what happened in Q1, well, in Q1, hedge funds, they added way more than what they were selling. And it's almost the same thing that happened with another company that I've covered that nobody showed interest when the price was extremely low. That was Robinhood, yes, another fintech company. But institutions were earlier than retail, despite Robinhood being an extremely big retail heavy movement company, whatever you want to call it. Again, you missed the boat from, 7, 8 to 17, and then you started to buy a little bit. It's always the same with retail. They buy high and they sell low. Unfortunately, it's not me saying this, it's the data saying this. It's not just for SoFi. We've seen that also in bear markets. That's when retail starts to sell a lot instead of buying. But okay, hopefully through time they learn their mistakes. I understand holding a bag for a while seeing the market go up and up and up, while seeing Nvidia, Microsoft, this and that go up and up and up, might not feel the best. But you don't have to prove yourself for a quarter or 2 or 3 or 4. No, you're here for the long term. That's the beauty of a retail investor. You don't have to show anyone the performance in the short term. So long as in the long term your thesis works out. Imagine you're a Tesla shareholder early days. Your stock was close to being zero, right? The company could have gone bankrupt. But what happened next? Well, you kept on holding and suddenly the stock went up 20-fold. I'm not saying it will happen tomorrow with regards to SoFi or any of your other holdings, but just purely looking, oh, the market is up and my bags are down. Oh, I must be a bad investor. Oh, this must be a bad company. No, unfortunately, that's not always how it works. Anyways, moving on here to the CFO chat with Mezua analyst Dan Dolev. Some pretty interesting comments were made there. Some things we knew, but some extra info that's always nice to get. So first up, with regards to getting the banking license. So what the bank provided us was a low-cost, sticky funding source. 90% of our member deposits today are coming from direct deposit members, and that's provided us with the ability not only to get great interest expense saving, we're saving about $500 million of interest expenses annually today as a result of having that lower cost funding and not having to rely solely on warehouse funding. That's great to hear. Moving up to Galileo Technicis, so we're seeing very robust demand and are in great conversation with a number of top banks in the United States and top banks in Latin America. We're in RFPs discussions with many of the top US banks right now. Now with these types of deals, sales cycles are a bit longer and can take up to 1 to 3 quarters to sign up a client. Then integrating takes longer than that. And then you start generating revenue. They continue by saying what I would say, with these larger, more established businesses, we're getting to a meaningful scale of revenue much faster than we used to when we were focused primarily on neobanks and fintechs, which means that once they get some deals done, the moment you're going to see the effect, it's probably going to be a pretty big one. Then with regards to guidance, GAAP profitability, all those things in 2026. So Dan Dolev asks here, you mentioned GAAP EPS. Obviously, that's a huge achievement. I think 55 to 80 cents in GAAP EPS in 2026. Like what are the main levers that you can pull to ensure that you're meeting or beating those expectations? By the way, this year, 8 cents is the expectations. So if they meet the higher end of that GAAP EPS guidance for 2026, that's a 10x. Yes, that's the thumbnail. Congratulations, you've made it to this part of the video. Bravo, comment down below. Anyways, moving on here, the CFO Chris Lapointe answered, so in terms of GAAP EPS, what gives us confidence there is that the guide assumes no incremental investment in new products, new services, no new acquisitions, etc. As you can imagine, our product pipeline is pretty robust, and you shouldn't expect us to sit around and not come out with new products and services over the next several years. which means they feel pretty confident meeting that goal, and who knows, maybe they can beat it as well. What we're assuming is 20 to 25% compounded annual growth of revenue over the course of the next 3 years. In financial services, we're expecting that to be 50% compounded annually every single year. Then he goes on by saying, if you look at these last several cohorts of new members that have come into the platform, approximately 30% of those new members are taking out a second product within 30 days of being on the SoFi platform. They've been generating over $2 billion of deposits each and every quarter over the course of the last year plus. They expect that to continue and to drive meaningful growth in our net interest income. Of course, with still a high interest rate environment, that's great for the company. Moving on to the last couple of things. This is the first time I heard this. Maybe I might have forgotten it, but they talk here about lending as a service business, which, similar to interchange, was $50 million of annualized revenue in Q1. They said that they're declining 80% of all applicants that are coming through the funnel, and that's serving as a really good addressable market for our lending as a service business in financial services. I mean, correct me if I'm wrong, but I think that's the first time we hear something like that from SoFi. Then, again, talking about tech platform, mid-20s% CAGR, and then lending is mid-teens CAGR. On the profitability front, bridging down to GAAP EPS, they expect to generate 30% EBITDA margin by 2026 and 20% GAAP net income margin by 2026 as well. SBC is expected to be high single digits as a percentage of revenue, which I think is completely fine. And last thing here, with regards to home loans, the acquisition of Wyndham Capital, the benefits of that, and the future, the huge opportunity here. So they see here that with regards to home loan business, right now, the overall market share is less than 0.1% of the overall market. I mean, once things turn in the economy, I think this is going to be a huge tailwind for the company. And so right now, if we look at the stock on the weekly, clearly not a good week right now with that ugly red candle. We're back to, well, where we were back in November of 2023. We also hit those lows here of around $6.4, $6.3. RSI is neutral-ish, but currently, yeah, we're in no man's land. Really not that good momentum with regards to the stock. So again, bad stock, not a bad business. I'll keep on repeating that. You can keep on laughing in the comment section below. That's completely fine. As always, do share your thoughts and comment down in the comment section below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye bye.